All right, good afternoon, everybody. Am I sharing my screen twice here? Stop sharing screen. All right. Good afternoon, everybody. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is the same as it was yesterday. Today's Thursday, October 9th. All right. How did we close? Negative. Negative on the day. SPY's down 0.3%. Qs are down a whopping 0.13%. And the IWM is down 0.5%. TLT is kind of flat here. Very notable move on this dollar, guys. Very notable move on what's happening with the dollar. It's been squeezing higher. It's incredible that there is no impact on the dollar on the stock market to me at this point. A few days ago, I was able to chalk that up to global easing. The reason why the dollar is higher is because the yen is lower because of their new prime minister over there is going to be an easy monetary prime minister. Uh, but now here we are a couple days later with the dollar continuing to squeeze, and I'm like, this is getting interesting, but still nothing is happening. It's dollar. It did seem to impact gold finally. We noted yesterday that gold's daily chart was actually beginning to go parabolic to the upside, which is one of the things that I am growing concerned that the U.S. equity market has to do in order to actually go down. That's like this is, I think, a perfect example when you look at this GLD chart of up then down, like what Bill Kay is always talking about where it's like, okay, trending higher, nice breakout, trending higher, and then it accelerates to the upside, and then you're actually able to break down. So we'll see what gold's next step is, but I would imagine that this GLD is not done selling overall yet. But there is some real structural stuff here behind gold's move. Oil, we've got down 1.4% on the day, still roughly in range with the lower end of the range. Bitcoin down 2% today. So that's notable. We've definitely seen crypto actually be a leader to the equity market. Ethereum smoked today, same deal. And that's really more the risk side of crypto and Solana as well. Also smoked today, down 5%. But once again, nothing with the stock market. I labeled the afternoon meeting for the YouTube today because I got to give it like a name every day, and I usually try to give it a whole 30 seconds worth of thought. Um, the afternoon meeting 2 trading sessions ago was not enough, and what I meant by that was, we had a down day 2 trading sessions ago, but I didn't think it was enough to trigger any of the stuff that we've been consistently talking about. It was a down 0.3% day. And yeah, we got the VIX to close above 17, but I felt like we needed to close on lows and the VIX needed to close on highs. And then we needed a gap down the following day in order for it to be able to begin to trigger. And I didn't think that the close was weak enough and we weren't down enough on a percentage basis. So 2 trading sessions ago was not enough. Today, the name of this afternoon meeting is not enough part two. Market, tried to be weak today, down 0.3% again, but 0.3% is still not enough to trigger any of our selling from the realized volatility systematic cohort. It's not close enough to our CTA trend following lines. It's not enough for any significant ETF rebalancing. It's not enough to create a VIX squeeze. As a matter of fact, the VIX got crushed into the close and almost closed on lows at like 1640 or so. So once again, not enough. Once again, we are at the same situation that we were at 2 trading sessions ago. Sure, the market had a down day today, 0.3%. Yeah, the 0.28%, Bill. So the market was pricing in a 0.28% move today. So we did exceed that, right? um, but once again, just not enough to really trigger anything. We are in the it did outperform. We are in the second day here in 3 trading sessions where we have a close into the ADMA on the daily chart, but it continues to be uh no break of anything, and it continues to be not enough to trigger stuff. I want to review and rehash a little bit now. Sometimes in the morning meeting, the morning meetings, I really try to make them more about game planning and idea generation. Sometimes explaining the thought process behind my game plan can get a little bit complicated because I need to go into some of the data and the information and everything that we're looking at. But I've got much less time in the morning meetings, so I can't really go into like in-depth stuff. Yet sometimes I get a little bit long-winded about trying to explain everything that we're looking at and all the updated information. But then we get a little bit more time in the afternoon meeting, and I want to just kind of re-review some of the stuff that we discussed in the morning meeting today. Now that I'm not in much of a rush, especially within the context of the person in the YouTube yesterday who gave me the commentary about why I'm so keen on hoping for downside, even though I don't personally think that that's the right way to think about it. Not necessarily hoping for downside, because every single day I'm talking about how the trend is your friend, and every single day I am calling out long trades, right? Today we talked about NVIDIA long, we talked about Tilray long, we talked about Delta long, we talked about CoreWeave long, talked about all that stuff in the morning meeting. Every day we're recognizing the trend is your friend. But I thought that Heisenberg note, which was a summary of Charlie McElligott, so I just want to rehash some of the stuff from the morning meeting. Um, Perfectly described what I've been trying to get across to you guys, and I think it's worth going over again. And it's this paragraph from Heisenberg, where again, so I am going to be giving my summary of Heisenberg, who is giving a summary of Charlie McElligott. But I'm just going to read this paragraph because I think it describes where we're at perfectly and what I'm consistently trying to get across when people think that I'm hoping for downside. And here it is. I've used the word asymmetric over and over again lately while describing the deleveraging risk associated with that mountainous exposure. And when he says mountainous exposure, by the way, what he's referring to is like the systematic longs, the vol control longs. Exposure, which, to reiterate, is dictated by realized volatility levels. That exposure gets dialed up into receding realized volatility, and past the point, there's no more to sell in the presence of a vol shock than there is to buy on a continuation of benign market conditions. That's asymmetry. So there's more to sell in the presence of a vol shock than there is to buy on continuation of benign market conditions. That's asymmetry. So that's really what I'm trying to get across here. When we are studying positioning, we at a certain point can recognize that there becomes an asymmetric risk to the downside, where that risk of a violent down move is so much greater than the risk in a lot of ways of the buying in these benign market conditions and the upside grind um, that we're dealing with, right? And that's exactly where we're at again with this market. And then they kind of get into the numbers here, where he's actually referencing a more extreme situation from Charlie McElligott. Charlie kind of gives the full gamut of kind of different outcomes, but like a 3% down move could lead to $90 billion worth of selling. Heck, even an up move, a large up move, we're actually at the point where it would be met with a lot of selling. And that's very, very different than where we were in May, June, July, when actually there was asymmetric risk to the upside. That if realized volatility came down from where it was in April, that 1 month, that 3 month look back, it's going to create a massive bid underneath the market. And that helped boost us higher for months and months and months. And when people say, don't fight the Fed, uh, sure, I generally agree with that statement. I like the statement, "Don't fight the systematics." I think that's even more powerful. Um, don't fight them on the way up when they're buying. Don't fight them in that May, June, July period when we're seeing that they're buying massive amounts every time. And when you get into this point where there's asymmetric risk to the downside, you need to be prepared for that, because it's not impossible just to wake up one day to a massive downside move if it were to ever trigger. I mean, in an extreme situation, a 20% down move would be met now by $500 billion of sell flow. That's not going to happen. The probability of that outright crash, that hypothetical outright crash of 20% down move, is not going to happen in a short enough of a period of time, I think, to trigger the $500 billion sell flow. But that's just the point. And then the other comment here that is worth repeating that comes from Charlie McElligott again is if the AI singularity goes wrong, or if any number of potential vol catalysts, for that matter, drive an old school core one, correlation one, risk off move, there's just so much mechanical deleveraging and exposure reduction sitting out there. That's what the asymmetric risk is to the downside that we need to be prepared for should it actually ever trigger. And that's what I'm watching for pretty much all day, every day at this point. Is this piece of news enough to trigger us? Is the selling enough to get us through that iron condor support level today? By the way, it was not. Can we actually begin to hit a point where the market could go down by more than 0.5% in one day? I know it sounds so crazy. That could actually begin to trigger some additional selling from other cohorts that could begin to force us down. And by the way, this increase in correlation, this old school core one risk off move, that's one of the other big things that we want to be paying attention to right now. Is we need to be watching if correlations look like they're increasing intraday, because that's been the other big feature of how this market has been trading, has been that dispersion. SPYs with very low realized volatility, the S&P with very low realized volatility, but individual stocks underneath the surface, they're actually trading at their average or their median volatility levels, and that's because you're getting dispersion. You're getting AMD up 40% in 3 days, and you're getting something else that's acting really weak, and then you're getting Nvidia up 2% today, but you're getting, maybe it was Apple or Google or whichever were weak in order to be able to offset so that the SPYs could still actually be down with Nvidia being up 2%. So underneath the surface, there's a lot of volatility with individual stocks, but that's just a dispersion move that creates for no volatility at the index level. And then that thought process of volatility increasing actually led to this great note from Bank of America that pretty much, says the exact same thing here. We see the risk lying in correlation upticks forcing index vol higher rapidly. So in a correlated shock, like the Liberation Day shock earlier this year. So basically, that's where Bank of America is seeing the risk. Bank of America is seeing the risk on that correlation upticking at the forcing index vol higher, which then could rapidly create that correlation shock that increases that goes into all of the actual selling that's otherwise. So whether that happens through an event like Charlie McElligott was saying, or whether that just happens because on its own correlation upticks, it's something that we need to be very, very much prepared for. Now to get into a little anecdotal fun. So going back to this commentary, I want to talk about, these number of potential catalysts, these numbers of vol catalysts, right? We've mentioned as a team here recently the idea of like gray swans that could potentially occur. That could be Japan, that could be France, that could be the United States, even with the hecticness that's going on. Obviously, so far, the market has 150% ignored the fact that we are on day 9, I think, of the government shutdown. Again, just to note, when the shutdown first started, we read a research note that said that it may begin to impact the stock market after we're shut down for 2 weeks. We're getting closer to that 2-week mark, but there's no surprise here that after 9 days, there is no impact at all on the stock market. And if anything, I can't help but wonder, had we been getting employment numbers and things like that, what the market would actually be doing. Could there have been any shocks in there, or did we just remove, with this government shutdown, one additional piece of information that could have actually been a shock that could create the increase in correlation? But what I want to talk about again is the AI trade here. So I want to bring up 2 things. One is also from Charlie McElligott's note. I posted it in the VTF early this morning. I just posted a couple highlights from that note, so I got to scroll up and find it. And then the other is going to be more anecdotal, and we can chat a little bit about my experience with Sora 2, which I am now on Sora 2, which is funny because if anybody knows me well, then you know that I like my worst two things in life as far as the skill set goes are my skill at technology. I'm terrible at technology. And my second one is my skill in terms of art or anything related to art. I have absolutely zero skill. My wife comes from a family of artists. My father-in-law is like an incredible artist, and I can barely draw a stick figure. So I can't bring this over onto the other screen, but I'll just read it. I posted this in the VTF. It's from Charlie's Note. I posted it at 7:01 a.m. And I just want to read what he was seeing Tuesday morning before the Oracle headline hit. So I'll just read this part out loud. So Tuesday morning, before the Oracle headlines temporarily spooked folks on weak cloud margins due to due to heavy spend renting NVIDIA GPUs. So prior to that, we are seeing what I'd have characterized as near some sort of local peak grabbiness slash AI euphoria in the vol space. Kind of a maximum spot up, vol up. Let's just type up the SMH ETF while I'm talking. Some sort of a maximum spot up, vol up with AI proxy SMH call skew touching 100 percentile over the past 1 year. And then it goes on to say, because the investor urgency remains tilted to hedge the right tail versus the left tail in the space, despite the significant crowding ownership of key AI stocks, which just so happen to still be trading inches away from their all-time highs made in prior days. So this was a couple of days ago, right? So we're going back here to like October 6th into the beginning of October 7th. He was saying that he was beginning to see like in terms of this concept of vol up, spot up, which we're always talking about at the index level, that in semiconductors specifically, and you can see when you look at this SMH chart, that this part was beginning to go parabolic when that Oracle headline actually hit. And that seemed to be getting to like a peak where it may not be able to be sustained. And then the Oracle headline hit. So you got this weekday in the SMH, and the next day you got the AMD headline that hit, and immediately AMD's a massive, or actually, no, that was the not the headline, it was the continuation day. That was yesterday. It was the continuation day higher in AMD, and that was the day when we saw massive call buying coming into AMD as well. So it continued to boost this SMH higher. And then this morning, we got NVIDIA. Interestingly enough, I thought that the market was going to gap up this morning, and it was a flat open, and that was despite AMD, and that was despite NVIDIA having its 190 breakout today, also on news. So circling back to the original thing that I was saying about like where is the catalyst on this market? Like one of the big things that I think that we have been talking about as a team a lot recently is like this idea of there being basically two economies right now. One economy is, well, you can see it in Home Depot stock recently. You can see it in Lowe's stock recently. You can see it in like some of these shadow banking stocks like an Owl. You can see it in retail. Those names are just not doing well at all. But when you look at the AI trade continues to be absolutely and utterly unstoppable. Yet, this is the interesting part about this environment we're in right now. Every single analyst out there, every single person that you hear talk says the same thing. Yeah, we're in a bubble. Go buy it. Which is such a crazy concept. We're in a bubble. Get out there and buy it. That's literally what everyone is saying. Which to me is a little bit crazy, but we get it, right? It goes back to what Paul Tudor Jones was saying a couple days ago on CNBC that a lot of the times the most amount of gain that you can get is actually in the last leg of a bull market where you are in the bubble, where that bubble's really building right before the burst, but you need to make sure that you have happy feet. And we want to be looking at positioning. We should be looking at positioning not just market wide, but we should be trying to look at it in this leading sector because I'll tell you what else. When you look at the weakening of the more general economy, or this concept that there's two economies out there, like the AI economy, the economy for the super rich, and basically everybody and everything else, what you got to remember is the everybody and everything else actually looks, or actually is, better than it would be otherwise, because the stock market is performing so well, because there is this concept of a wealth effect. The wealth effect means that when, and I know I'm this way for sure, when you look at your brokerage account and you see that your brokerage account is looking great and it's got a lot of money in it, and it's continuing to make more money, and it's at highs, you have a higher propensity to go out and spend money than if all of a sudden you took a 30% hit in your retirement accounts and in your retail account, and you're looking at it and you're going, man, yesterday I had $100,000 and now I only have $70,000. You have a much lower propensity to spend. So if anything, the weakness in the overall economy is being held up, and is actually doing better than it would be otherwise, because the AI economy, even if you're not directly involved in AI, it's making it so that your brokerage account looks better than it would otherwise, and it's making you get out there and go and spend. So the one of the bigger questions, I guess the big question, when we think about the asymmetric risk to the downside that we keep talking about, and how all of this selling could come in should it ever actually trigger, is where and how does that trigger actually come from? It could just come from an event. Something happens overseas in the middle of the night. We wake up to a large gap down because of an event, and then that just absolutely feeds on itself into a downside move. That could happen. Or it could just be that the sector that has been booning this market higher day in and day out hits a point where it does what gold did. Gold here, and obviously it's just one down day, but gold broke out, it went parabolic, and that becomes unsustainable, and now it's having the pullback. SMH here looked like it was just getting to that point, and when you go to that Charlie McElligott note from that day, they were getting into the 100th percentile in the call skew, and it looks like it's hitting the point where it can't continue for maybe too much longer. But I would take it with a grain of salt, because he said it's a 100 percentile on a 1 year look back. He didn't say it was 100 percentile on like a 10-year look back, but all the same, um, uh, that kind of that hits that point where it begins to come down. So that's like the data evidence, which is the best evidence to pay attention to. Anecdotally, to get into some more anecdotal evidence, I had some fun yesterday. I got access to this Sora 2. I actually had access to it a couple of days ago, but I didn't try it till yesterday after the close. And I spent way too much time yesterday afternoon building out all these silly videos of me doing crazy, unrealistic things. I was skiing with glow in the dark penguins. I was like trying to like make videos of me and my buddies like climbing mountains and skiing down them. Today I was driving in Ferraris. I made myself a ninja and I battled off like 10 samurai at the same time. I wish I could post some really good ones, David, into the VTF, but they don't. I can only get pictures in there. I can't actually get 10-second videos in there. Um, what else did I do? Oh, I woke up this morning. You guys know I don't follow sports at all, but I've got plenty of friends that obviously do. And I'm in a group chat with a couple of my really close buddies. I woke up this morning to a bunch of whining and complaining about New York sports. I don't follow sports, but I feel like these guys have been whining and complaining about New York sports for years and years and years at this point. So first thing I did was I got onto Sora and I made a fun little video of me being the best player on both the Yankees and the best player on the New York Giants at the same time, because the rest of the team is so bad. And I sent it over to my friends. Look, this stuff is pretty cool. It's actually incredible what it's able to do. It's really cool, and it's fun to play with. Is that worth spending $1 trillion on? Obviously, there's more to AI than just Sora. So I'm exaggerating here a little bit. Is it worth spending $1 trillion on? Trillions of dollars on? This goes back to the question that we were asking in an afternoon meeting either yesterday or the day before yesterday. There is no doubt in my mind that AI is changing the world. It's already changed my life. My ease of information for researching for stocks and things like that by using Perplexity is awesome. The thing, like just how quick I can come up with information compared to what I used to have to do. Get on Google, try to find the right links, end up being on 7 different links at once, reading all this time stuff to try to put things together. Now I can do it so much faster, so much more simpler using Perplexity, using AI. The Sora thing is super cool. I'm sure that it's going to have a revolution for cost savings in regards to making commercials, certain aspects of Hollywood and making movies, which may or may not come at the cost of additional jobs. Combining AI with robotics to have self-driving vehicles and self-driving trucks, so you don't need truck drivers anymore, and they can drive all night and that stuff. Don't get me wrong, I am, very bullish on where AI is going to be going in the long run. But is the video of me as a badass ninja beating up 8 samurai at the same time worth trillions of dollars? I just don't think that the juice is worth the squeeze. And somebody else, I don't, it might have been Josh, put like an interesting statistic or data point or whatever in the VTF at a certain point about like the amount of revenue that would need to come in order to justify the spending. How you just can't have any. I have no idea where it's going to come from. It doesn't look like it's going to be like anywhere close. To me, Sora, as cool as it is, I feel like is the NFT moment in some ways of AI. The NFT thing, and look, I've been dead wrong on certain aspects of crypto. We're still seeing crypto make all-time highs right now. And I'm not afraid to adjust my thought process. I used to be a hater on Bitcoin. Now I truly recognize the argument of Bitcoin being digital gold. I still can't get through into my brain to understand the importance of Fartcoin, which I think has like a multi-billion-dollar valuation. So I'm not fully all in on everything yet. You haven't quite been able to convince me on that one. But I'm not afraid of changing my mind. But when I saw the NFT thing, I was like, so you can own a digital photo, but I could just copy and paste it anyway and just be able to look at it in the same way as anybody else. Like I don't understand the value here, right? And then we saw the NFT market basically implode. And I know that there's still, for like a couple of the original very special NFTs, there's still a little bit of a market for them. But like the fact that everything became an NFT obviously imploded on itself. I almost see Sora as that. And so then I was curious, right? Because here I am. I've probably made like 25 videos of myself doing all this weird, funny stuff. And especially because sometimes you make them and they don't come out well. So then you got to make a whole new one and like adjust the prompts that you're giving it. And then, this is free. I'm not paying in any way. And when I say I'm not paying in any way, like I wouldn't say that Instagram is not free. I'm paying because I have to look at advertisements. It's not free. But when I'm on Perplexity, when I'm on this Sora thing, and I'm sure that they're gonna figure out ways to monetize it over time, but at least in the moment, there's no advertisements going on. There's no click here to buy button that's going on. So I asked Perplexity, I was like, about how much does it cost OpenAI for each one of these 10-second videos that I'm making? And the information that it spit back to me was between $1 and $3 per video. And I'm just thinking in my head, like, sure, I made 25 videos, right? So I just cost them $25, $75, something like that. That's how much money OpenAI has lost on me in one day because of me making these silly videos. But it's me times every single person that's doing it. And I just, as cool as it is, I don't see myself using Sora to make these fun videos for anything more than I use like the Bitmoji thing. Yeah, right? Does everyone know what that is? Again, I'm like one of the least technologically advanced people in the world, but like the fun little Bitmoji where you make like a little cartoon of yourself and you can like instead of sending like a meme or like a whatever, like a quick video, you can just send like a Bitmoji of yourself. And I still use those every once in a while, you know, send a happy birthday with my cute little cartoon self instead of just writing happy birthday. I don't see myself using this Sora thing any more than I see myself using that. And every time do use it, they're losing more and more money on it. I don't get it. AI is going to revolutionize the world, but is it going to revolutionize the world at the trillions of dollars of spend that is currently ongoing into it? Pretty much even the biggest bulls that are out there on AI seem to be saying no, right? Whether it's Jeff Bezos or I don't know why the guy's name is escaping me. Even the OpenAI dude himself. They're all like, "Yeah, it's a bubble." You know, we think it's gonna work. I mean, I guess Jensen Huang's been pumping it really hard, and these are the guys that are most incentivized to be pumping it, right? I don't understand. But the question is, when does the market say that, right? And this is just how markets work. We could Sam Altman, thank you. We could very, very quickly have just seen this happen 100 times, just like when it was NFTs, and the timing of it is so hard, but the technicals could potentially tell us the timing. The quantitative data could potentially tell us the timing. Um, Very easily at some point, if SMH drops 15%, the narrative is gonna follow price. That's what's gonna happen here. If SMH falls 15%, the narrative will all of a sudden become the spend is too much. They're never going to be able to make it all back, right? It'll be nothing will have changed except that price will have fallen down, and then everyone's going to say that the narrative is different. And all we need to do is recognize what the risks are, right? And I guess it just circles back to the same thing that I was saying yesterday, the same thing I was saying in the morning meeting, but we always want to update this and rehash this when we get new information from sell side analysts, like this, especially like a guy like Charlie or what's his face over at Citadel. When we get this updated data and updated information, it's just very important that we analyze the updated data and updated information for what it means. And I like my new statement that I just came up with because it's worked for 5 years and it has not worked for the last month and a half, at least not yet. But it's don't fight the systematics. When they are buying and you know they need to buy and they need to buy big, you should not be shorting into that in any real way. If the risk becomes asymmetric to the downside, like it is right now, it doesn't mean that we have to go down. It doesn't even necessarily mean that you shouldn't be buying. It just means that you need to know what the risk is. So you know what? Take the Nvidia along through 190. Take the Apple bull flag breakout if it goes. Take the RCAT breakout or whatever the latest crazy meme stock is that's going. Take them and get paid on them. But know your time frame. Don't marry the trades. Be prepared to get out. And also be prepared to sell the hell out of this market on the short side if any of this stuff is ever able to trigger. Because the flip side of the fact that this asymmetric risk has been to the downside from a positioning perspective for solidly over a month now, but has not yet been able to trigger, it actually means that the asymmetry of the risk actually just keeps getting worse. That's what that's actually meant also. The more we move up here, the more the buying that actually comes in the market, the more, especially if you can start to get these long funds in, it actually starts to get worse. And the real risk, the real ultimate risk, in my opinion, still continues to be, which we have not seen at all, we've only seen the opposite, is retail. Retail over the course of the last month, and this is probably what helped the market have the strongest September in 15 years, bought $100 billion worth of stock. They were the number one buyer. Lost the corporate buyback bid right now. They're in their blackout window. You've lost a systematic bid. They're still buying very, very tiny, It's just more that they're not selling. It's retail. And you think about it, the economy is starting to do worse, but Americans love to spend, but the wealth effect is still holding things up. So there's a chance that you could get like a waterfall cycle of things that feed on itself with the market pulls back and then retail's losing their jobs, but they're also now getting a hit in the stock market at the same time. Then instead of buying $100 billion worth of stock, maybe they're just not buying. And wow, if you could combine all of that together, then you actually have a bear market. Now, I'm not calling for a bear market here. All I've been calling for is that the continuation of the market to the upside over the course of the last month is unhealthy. That's the biggest thing I'm saying about it. I'm not even saying don't buy it. I'm saying that the continuation to the upside in this market has been unhealthy, and it would actually be healthier for the market if it could unwind some of that asymmetry and then get back to new highs, like we saw very consistently in the uptrend in 2024. This uptrend in 2024, in my opinion, is a much healthier uptrend than the uptrend that we have seen in the last leg here of 2025, right? This was a environment where in 2024, by the way, we predicted every single pullback that happened in all of 2024 pretty much in the exact same way that we're doing it now, except this time it hasn't happened. Because systematic exposure gets full, the risk becomes to the downside. You get a 3 to 5 to 6 to 7% correction to the downside. That little correction to the downside unwinds the systematics. Then they begin to buy. When you get back to the previous high, they're actually still having more ammo to be able to buy. It pushes the market up for its next wave higher. Then they get 100% in the pool. Then you get the pullback. It unwinds it. You get back to highs, but they're not fully in the pool. Then you get the continuation. You get the pullback, rinse and repeat over and over and over again up until February of this year, where they were fully in the pool. One of the bigger differences in February this year that we don't have now, though, that I keep talking about, is that hedge funds were long at the 97th percentile. Hedge funds have not been that long this market, but they have been getting squeezed out of their shorts in this market recently, which actually also now will begin to help the asymmetric risk, I think, to the downside. That's actually what more of a healthy bull market looks like. Higher highs and higher lows, pullbacks, resets, readjustments, and that actually creates good trading opportunity for us as well. This environment this last month plus here has been buoyed higher by central banks, which is not a bad thing at all, by the way. I mean, you could argue it's a bad thing, but you need to recognize that's one of the bigger things that's happening. All the extra liquidity that's coming into the market has been boosting the market higher. That's why now the market's still moving higher with the dollar moving higher because of Japan, right? But it's the same thing. So one is just wanted to rehash some of the stuff from yesterday with the comment about like why is Derrick always looking short recently in a market that's uptrending. But two is I wanted to rehash it with the updated data that we were able to get this morning from Bank of America on correlations and from Charlie McElligott at Nomura on on all the systematic positioning and kind of how and where we are here with this market. But the bottom line is, well, we did have a nice little 0.3% down day, one of the biggest down days we've had in months. um, the trend is fully intact. Can we ever hit a point where enough selling can come in to actually break the trend and trigger forced selling is to be seen. And it's not a matter of if, it's a matter of when at this point. And the when is important too, because if we get to basically the very end of October, start of November, and we haven't had that pullback, then you start to get the corporate buyback bid that comes into the market again, and you get new positive flow of funds that come in as well. It's very hard to fight November and December bull flow. I think that the statistic is that Q4 is positive 80% of the time, or maybe slightly less than 80% of the time. So that also means that you get that one in every five, or Q4 is negative. Maybe this will be that one. I don't know. I think 2019 might have been, right? Was it 2019 or was it 2018? I think it was 2018 when we had the little tantrum with the Fed, that brought us down, that then Powell pivoted very quickly. Anyway, that's all I got. All big picture, all macro. Could get into the small picture with some of the names we traded today and RGTI and everything else, but I took a lot of time there, and I do have a event that I have to get to at some point this evening, though I'm not in a particular rush to get to it. So I'm happy to turn it over to you guys for questions and comments. Um, so the first thing I'm seeing here is from Liam. I'm curious to hear your thoughts on this Reddit chart. Kind of looks like a textbook bear flag with the test of the ADMA here, but got some good news today on user growth. Also curious if you put on Oracle. Yes, starting with Reddit. So what we want to remember is what the definition of a flag actually is. A flag is a continuation pattern. So the first thing and I'm a stickler for my definitions, maybe too much, but I think it's important because it helps us understand concepts. The difference between a bearish consolidation and a bear flag is a bearish consolidation means that price went down and then went sideways. A bear flag means that you were trending lower and then you went sideways and time corrected. So the question is this a bear flag? The answer to that is, were we downtrending into it? And you can make the argument, yes. We were having a smaller time frame downtrend in Reddit with relative weakness since mid-September. You've got a high, you've got a low, you got a lower high, you got a lower low. So I think it's fair to call this a downtrend. That's the first thing I want to do. So it doesn't look good, especially if it can lose $200. Two things to note, though. One is your layers of probability. You're looking at a bearish pattern. Is the market moving up or down? The market's moving up. So that means that this bear flag has a lower probability of success because you're probably fighting the market, unless, of course, the market breaks with everything we just talked about. But you're probably fighting the market. So that would be the most important thing I would say. And then secondly is the number one way that technicals can change very, very quickly is news. And that's even what we're talking about with the market, right? If we ever were to have bad news overnight and have a nasty gap down, we're going to probably pull back really hard off that. So here you had good news come out, and now it looks like it's trying to break its bear flag to the upside right as that ADMA caught up. For me, there's no trade here. I don't want to fight the market. I don't want to fight good news that came out by shorting this thing. I would rather short momentum through 200 if it's able to break below it than try to short at the resistance of the bear flag in a strong market after it had positive news. That's my thoughts on that. Next, curious about your opinions on Oracle. So Oracle is one of the big ones that we got to be watching because Oracle was that potential canary in the coal mine 2 trading sessions ago, and now it's above that high. By the way, Palantir was also one that had negative news 4 trading sessions ago, and today was testing that high. So just incredible how well this market ignores bad news. But I think it's notable that it closed below 300, but also closed above the negative catalyst candle. To me, that's what's more important. Closing above the negative catalyst candle is what's most important to me. It's fully negated it. It has said, the stock market has told us that it does not matter that Oracle is going to be losing $100 million a quarter on renting GPUs that are going to get old over time. It's a name that I would like to belong, but I don't really know what to do with it. Oracle is currently building out the biggest cloud infrastructure in the space, and initially thought the risk of news would be to the downside, but maybe now that has proven untrue. Thought initially that news could cause us to fill the gap. The market also looks like higher. Yeah, I keep it simple, stupid. I think you can be long this thing as long as it's above the high from 2 days ago. That's it. Scrolling down here from PS. Last 50 years of stock market price action has occurred with debt to GDP below 100%. My understanding is above 120%, which is now financial assets get priced beyond just earnings. That is really interesting. And that debt is continuing to increase. I mean, that is that is one of the that's one of the, I mean, that's like the big bull arguments, right? It's one of the big bull arguments that I'm on board for that still exists, which is that we are stimulating everywhere you look all around the world. From a Federal Reserve perspective and a federal government perspective, we're going deeper and deeper into debt. Um, it seems like the real story in a lot of ways is inflation. We spent a lot of time talking about tariffs in regards to inflation, and the impact has only been moderate thus far. My bigger concern now is more, um, if you already have inflation moving higher, but you're going to continue to run the government at a deficit, not just the United States, but around the world, and at the same time, also be cutting interest rates, what's that going to do to inflation? Where you could have like, instead of having like a 20% down move in the market, you could have a market that moves sideways for a couple of years, and over the course of that couple of years, you have 20% inflation, and from a real return perspective, it becomes the exact same thing. So yeah, I mean, it makes sense to me that all these assets would be buoyed higher uh, at that level of debt spend to GDP. Um, so yeah, sure, it's scary bigger picture, but we'll see what happens. Blackstone had a video out yesterday saying inflation is lower than what is being reported. A prime example was rent, which came in 3.1%. They own billions of real estate, and their number is 2.4%. Oh wow. Okay. I haven't seen that. So definitely good to know, but you got to think that inflation is going to accelerate if we're spending everywhere and cutting interest rates at the same time. But maybe it won't. I really don't know. If I'm going to make a counter argument to my own argument that I was just making, um, I had been making an argument back in 2024 or 23. I don't even remember. Maybe you do. Remember me saying it. That is that the high interest rates are actually spurring inflation because the biggest companies in the world and the richest people in the world, all of their debt is at like 2, 3, 4%, but they're able to get 4, 5, 6, 7% on the cash that they actually have, and that inherently is inflationary. And if rates come down, you actually might lose some of that funny money. So, you know, you think you know some things based on traditional economic theory sometimes, and then there's so many dynamic influencing factors on everything that sometimes you don't get the expected outcome because of other things that are ongoing. So who knows? But I would generally would think that rates coming down and more government spending would boost inflation higher. But we're not going to know because we can't get the CPI number anyway. Those numbers or anything. But of course that's bullish. From Dr. J, it's a brave new world. It's not just bulls versus bears, but it's also long-termers versus short-termers, speculators versus quants, retail versus smart money, chaos theory at work. Take your pick. Yep, great point. From Jerry, Meta has not moved in conjunction with the Qs in over the past month. How would you play it where it is now? I still think that Meta for now is a short. Oh, it closed above 7. Is this up here? Wow, I didn't realize how strong Meta was today. I probably should have realized that. So I liked Meta as a potential short into the 730 area. The 21 EMA is up at 738. I would not buy this chart here. I would start by saying that. Um, there's too much resistance ahead. You're buying into the upper band of equilibrium, which is still declining in what has overall been a relatively weak stock. So I certainly wouldn't buy it. I thought and still think that it could be a short in this area, but given the fact that it got back above 730, I would only consider shorting this on the way down after it gives a pivot. This thing could go to 740 and still create that pivot and still actually be bearish. So you don't want to just be on the wrong side for another $7. you're currently short, I would just make sure that you manage your risk on it, or that your tier size is really small at this point, because the close above 730 has this thing looking a lot better. I still wouldn't say it looks good. I would, like I said, I would still rather be short this name than long it, but it's similar but different to when we get like that nasty negative Maribozu candle. Like, how did NEM close today? Someone was asking me about NEM. Like, I don't want to buy NEM, and it closed a little bit off lows, but I don't want to buy a stock that's been uptrending like this that then gives its like first negative Maribozu candlestick where it closes on lows. I don't want to be buying that the next day. In the same way that even though Meta's been the very relatively weak name, I don't want to be short this name or shorting this name after it had its first really strong day and closed on highs that it's had in a while. It kind of puts it in the penalty box for someone who's short. Though I wouldn't say that it puts it in the clear for someone to be long either. You know, you still could get that pivot high as like 740 and have this thing still be weak. They only give you like a couple of the invites to that Sora thing, and unfortunately I gave them all out already to a couple close friends and family members. Otherwise I would hook you up. Somehow I gave Josh Leffler one, which was a mistake because he's been sending me videos of him driving and flying Ferraris all day. Um, from Liam, would you consider Reddit a bad long for tomorrow? I don't like this as a long here. I guess it could be a failed bear flag, leads to a big bull move with news into a gap, but I don't like buying weak stocks into a declining moving average or into a declining, equilibrium zone. All right, let's see what's going on in the YouTube. We've got a bunch of comments in here. First from IR Joel. We are talking about Melly yesterday. I got super lucky today. I didn't look. I don't really look at this one too much. A big update on that Melly. Good stuff. Got super lucky today and got out of my 2,300 calls at break even after lowering my average. Those premiums are not cheap. Okay. Glad you caught the move. Um, I for sure spend more when my retail account retirement account is at highs. Yep. Very common thing. From Jacob, agree with your comparison on NFTs and Sora. How do you think that improving AI models will shape the future for trading algorithms and trading firms around the world? You know, this is a question I feel like I've been fielding for 10 years, even before AI was a thing, because the algorithms have been around for so long. I've been getting this question for a long time, just on how can you compete with the algorithms and things like that. Obviously, they're just going to continue to get better and more sophisticated, but in the equity market, wealth is created and destroyed, and I think that there is always room for everyone to actually be able to be a winner. So I would say, like, if you're a trader in this market, don't get yourself in a tizzy and get all crazy about the fact that there are algorithms out there that might be smarter than you or have better performance than you. It doesn't matter. That's not your performance. What matters is your performance. And you can make money in conjunction with them making money. Everybody can be making money together. What matters is your game plans and your strategies and your consistency and your risk management and your discipline with your risk management. So that's a short answer. Thank you for the question. From Cyril, so potentially the crash will be bigger and faster. Potentially. From Sherry, if Captain Condor, this is the big one. This is the big one, Sherry. So Sherry's saying if Captain Condor was not here today, I think the gamma flip level would have been triggered. LOL. So that was the big thing, right? So Captain Condor was sitting there today and creating the support in this 67.15 to 67.20 spot. And we were heavy into that 67.20. And we were saying, can we break through the support that Captain Condor is artificially creating here? This gap. We don't need supportive flows in this market right now. We're actually having downside and have a chance to be able to break the downside. I am so curious, but this is just how markets work, right? You need everything to come together. You need everything to come together at the same time. I am so curious. If the Iron Condor wasn't there today, could we have breached through what was our low today and closed on lows and had a better VIX close and today's afternoon meeting is titled Not Enough Part 2. Maybe I'd be having a different title in my afternoon meeting if Captain Condor wasn't there, and I would be saying, ooh, is that enough? I don't know. Maybe the selling comes in tomorrow and he's not there to push us deeper. Maybe that's what happens. I don't know. You know, tomorrow is a Friday. Sometimes Fridays can be a little bit interesting, especially with all the melodrama that's been going on recently. But the other joke that I'll make, you know, because we can't predict the future and we don't have crystal balls like that, is you know, I keep making the same jokes. How much we're going to gap up tomorrow, and which company's going to announce an AI deal tomorrow. Who's going to do it? Which company's going to announce the AI deal? Every day we get an AI deal that boosts the market up. Because the other thing you could be potentially saying to yourself is, what would this market have done if Nvidia, you know, the largest market cap company, was not up 2% on the day, to also help bolster this market higher? The cynical answer to that is something else would have been up to keep realized vol down, but maybe not. Steven asking me for thoughts on NBIS. The stock is a monster. It's my thought. I got out of my long at like 70. Stock's a monster. Looks great again. Technical pullback into equilibrium, inside and up. It's one of my favorite continuation patterns, by the way. So this is a good pattern you can learn from. Technical pullback to the ADMA, inside bar for continuation. You can check that on a 5-minute chart, or 15-minute chart, or daily chart. So today is a day one again. This thing looks like it's going higher. Looks great. So some flow in the PM, and then it went on the Microsoft forecasting data center constraints through 2026. Okay, yeah, looks great. From Cyril, today my trade of the day was when the ES futures did a failed breakout on the 2-minute at the open. Okay. I don't really look at the twos, and I'm just gonna look at the spies. Yeah, we tried to go in the beginning of the day. It was a little scary for anyone that's got shorts on. But yeah, failed break higher, moved down to that 6,800 support, and then retraced 6,800 level. All right, good stuff. Good stuff, Cyril. Um, Back over in the VTF. Walmart's gonna be the AI deal, or did it already come out? All right, guys. I'm gonna wrap it up there because I gotta run. Have a great night, everybody. I will see you all tomorrow.